Hello, everyone. Today I want to talk to you about what quantitative traders actually do, beyond the buzzwords and into the real, day-to-day operations. This isn't just theory, it's about how quant traders research, build, execute, monitor, and refine strategies in real markets like equities, crypto, and forex. Whether you're a retail trader dipping your toes into algo trading, or an intermediate quant looking to level up, this will give you real-world relevance, practical insights, and actionable tools. To give you a sense of how a typical day in the quant world begins, let me describe my own routine. I start by checking what happened overnight, looking at macro news, volatility spikes, or sudden price moves. Quant traders work within a feedback loop where being up to date isn't optional, it's critical. If you're in a small shop or trading independently, you might be the researcher, developer, and risk analyst all at once. Then comes the process of data collection and research. Quantitative trading always starts with data, clean, diverse, and extensive. This includes everything from tick-by-tick prices and order book depth to volume flows and alternative data like sentiment scores, economic indicators, or even satellite imagery. For crypto, I often pull tick data using APIs from Binance or Coinbase. For forex, I might use historical feeds from sources like Quandl or Bloomberg. Once the data is in place, I begin forming hypotheses. For example, do small-cap equities with large overnight gaps tend to revert by midday? Or do correlated altcoins diverge and then snap back? These hypotheses are then statistically tested using regression, autocorrelation analysis, and time series modeling. The next stage is model development and backtesting. Once a hypothesis passes the sniff test statistically, I translate it into code. I use Python, Pandas, NumPy, stats models, scikit-learn, even Profit for time series forecasting. Jupyter notebooks are great for prototyping. Then I move into production code using platforms like Backtrader or my own backtesting engine. Here I run in sample and out-of-sample tests, perform walk-forward analysis, and use Monte Carlo simulations to see how robust the model is. I look at Sharpe ratios, maximum drawdown, win-loss consistency, and strategy decay curves. Backtesting hygiene is essential. No look-ahead bias, no data snooping, and costs are always baked into the simulations. Now comes the execution and monitoring phase. Once a strategy passes backtesting, I deploy it live using execution APIs, interactive brokers for equities and forex, direct exchange APIs for crypto. The strategy listens to real-time data, executes trades according to signals, and adapts to new conditions if it's dynamic. For market-making strategies, it constantly updates bid and ask quotes. For trend-following models, it watches for breakouts. I monitor this execution with a risk dashboard. I check P&L in real time, exposure limits, drawdowns, and latency metrics. I use alerts and kill switches in case something goes wrong, because when it does, you won't have much time to react manually. After the market closes, I move into optimization, review, and iteration. This is where I evaluate the day's trades, check if slippage was higher than expected, revalidate signals, and fine-tune parameters. I also track how my model performs across market regimes. If volatility is spiking, is the model holding up? If not, I might retrain it, remove decaying signals, or pivot to a different approach entirely. This process is never really done. Markets change constantly, and even good models can degrade within months if left unattended. Now let's talk about the kinds of strategies I typically work with. The most common is statistical arbitrage, also known as pairs trading. This involves finding two correlated assets, say, two banking stocks or two crypto tokens, that temporarily diverge, and betting on them to converge again. Then there's mean reversion, where you expect prices to revert to a historical average, often triggered by volume surges or volatility contractions. Momentum or trend-following strategies look for directional moves and aim to ride them for a while. These are popular in equities and crypto, where retail flows can amplify trends. Market-making strategies are another category, where you profit by placing bids and asks and capturing the spread. This is high risk, low margin, and highly dependent on execution speed. High-frequency trading, HFT, deserves a separate mention, ultra-low latency models that exploit microsecond inefficiencies. But they require co-location, specialized hardware, and deep knowledge of market microstructure. When it comes to the tools and technologies I use, my stack is pretty standard for a quant developer. Python is the backbone. I use pandas and numpy for data handling, scikit-learn and stats models for modeling, and backtrader for backtesting. I connect to live data via APIs, interactive brokers for stocks and forex, MetaTrader for discretionary overlays, Binance or Coinbase for crypto. Risk analytics come from custom scripts or libraries that handle Monte Carlo simulations, value at risk, VAR, and liquidity stress testing. I use Git for version control and host parts of the infrastructure on AWS or Google Cloud, especially for models that require scalable compute. Based on experience, there are a few key best practices I always follow. First, always start with a hypothesis, not just code. It's tempting to throw data into a model and hope it finds something, but that usually leads to overfitting. Second, build backtests that simulate reality, include latency, commissions, slippage, and position limits. Third, model liquidity and market impact. A great model in theory might fall apart when it tries to execute in a thinly traded asset. Fourth, constantly monitor your models after deployment. Just because it worked 6 months ago doesn't mean it will today. And finally, diversify not just across assets, but across strategy types. Momentum and mean reversion might complement each other, while market making adds a different exposure altogether. Now let's get into some of the controversies and risks involved in quant trading. One major concern is the potential for market manipulation. Some firms have been fined or prosecuted for practices like spoofing or quote stuffing, where orders are rapidly placed and cancelled to manipulate prices. The 2010 flash crash is often cited as a symptom of unmonitored algorithmic systems gone wrong. Another issue is structural risk. In times of stress, liquidity dries up fast and algorithms can exacerbate price moves rather than dampen them. Regulation is catching up. In India, the NSE county location scandal raised concerns about unfair advantages in latency access. And then there's the issue of strategy crowding. Once a quant signal becomes widely adopted, its alpha disappears. That's why continual research and innovation are not just encouraged, they're required. As Man Group's quant CIO once said, "If you stand still, you decay." So, why does all this matter? For retail traders or beginners, understanding what quant traders do helps in two major ways. First, it teaches you how to approach markets systematically. Instead of reacting emotionally or following news headlines, you learn to test your ideas with data and make evidence-based decisions. Second, it teaches you how to manage risk, not just in terms of stop losses, but holistically, across your entire portfolio, in terms of drawdowns, liquidity, and exposure. For more advanced traders or intermediate quants, this understanding provides a roadmap to take your strategy from a notebook sketch to a live, monitored trading system. It also shows you where pitfalls lie: overfitting, neglecting execution costs, and failing to adapt when market regimes shift. As we wrap this up, I hope you now have a deeper understanding of what quant traders actually do. How we take a hypothesis, test it rigorously, build models, deploy them, monitor risk, and continuously adapt. It's a cycle of research, validation, execution, and revision, powered by technology, governed by discipline. If you're just starting out, Try building a simple momentum model using Python and Backtrader. Use free data from Yahoo Finance or Binance, simulate basic costs, and track your performance. If it works, connect it to a paper trading API like Interactive Brokers. And if it doesn't, ask why. That's how the learning begins. Quant trading isn't magic. It's not about having the perfect formula or buying secret signals. It's about asking good questions, being skeptical of easy answers, testing everything, and managing risk like your capital depends on it, because it does. Done right, quant trading can offer a consistent edge in equities, crypto, and forex markets, even in environments where discretionary trading struggles. Thanks for watching. If you found this valuable, please like and subscribe, it really helps the channel. Drop a comment if there's a specific strategy or tool you'd like me to explore next. Until next time, stay curious, trade smart, and never stop learning.